Bitcoin or Ethereum? It's the question every new crypto investor asks, and the answer most people give you is wrong because they're answering for themselves, not for you. If you're thinking about investing in crypto, you've probably faced the big question: Bitcoin or Ethereum? It feels like the first major decision every new investor has to make. On one side, you have Bitcoin, the original digital gold. On the other, Ethereum, the world computer. They're often lumped together, but they are fundamentally different assets with entirely different goals. So, how does a regular person, without a degree in computer science or finance, even begin to choose? To answer that, I decided to approach it systematically. Today, I ran both through an AI analysis framework built specifically around a normal person's financial situation. And I have to say, the result might surprise you. Now before we dive in, I want to be absolutely clear. I am not telling you what to buy. That's not what this channel does, and you should be wary of anyone who tells you they have all the answers. What I'm doing is showing you how to about this decision. We're building a mental model, a framework for analysis you can use for yourself. And in this process, we're using AI as our analysis partner. Think of the AI not as a crystal ball, but as an incredibly powerful, unbiased research assistant. It can process decades of market data, technical documentation, and economic reports in seconds, helping us cut through the noise, the hype, and the fear. So, what exactly did we ask our AI partner to look at? We didn't just ask, which is better? That's a useless question. Instead, we built a comprehensive comparison based on key fundamentals. For Bitcoin, we're analyzing its identity as a store of value, the security of its network, and the powerful economic model of its fixed supply and the halving cycle. For Ethereum, we're focusing on its utility, its vast ecosystem of applications in DeFi and NFTs, its ambitious roadmap towards greater scalability, and the implications of its shift to proof of stake. But we don't stop there. The most important variable in any investment is you, your goals, your risk tolerance, your time horizon. That's why our framework also includes different investor profiles, from the conservative wealth preserver to the balanced builder to the aggressive growth seeker. We'll explore how this decision looks different for each one. We'll even get into the practical side of things. The pros and cons of holding coins directly versus buying an ETF, basic security practices, and how to think about dollar cost averaging to manage volatility. This isn't just a theoretical exercise. We're going to ground this in a real-world case study to show you how these concepts work in practice. By the end of this video, you won't have a simple buy this recommendation. You'll have something far more valuable. A clear, structured way to decide what's right for your own financial journey. Let's get started. Bitcoin. The case. Bitcoin is digital gold. Simple, scarce, 21 million cap, forever. It has the longest track record in crypto, 15 years of data. Institutional investors, ETFs, and government reserves now hold it. If you want to store value over a long time horizon and sleep well at night, Bitcoin is the cleaner bet. Ethereum. The case. If Bitcoin is digital gold, then Ethereum is the foundation for a new, decentralized internet. It's often called the world computer, a global, open-source platform that's not controlled by any single entity. This fundamental difference is where the investment case for Ethereum truly begins. It's not designed to just be a store of value. It's designed to be a utility, a digital infrastructure that anyone can build on. At its core, Ethereum runs on smart contracts. Think of these as self-executing agreements where the terms are written directly into code. There's no need for a middleman. This single innovation unlocks a universe of possibilities, creating what we call decentralized applications, or DApps. The most prominent of these is decentralized finance, or DeFi. DeFi aims to rebuild the entire financial system, lending, borrowing, trading, and earning interest, without banks or traditional institutions. It's a world where you have full control over your assets. Then there are NFTs, or non-fungible tokens. While they gained fame through digital art, their potential is far broader. An NFT is a unique, verifiable digital certificate of ownership for anything, whether it's a piece of art, a concert ticket, a university degree, or even the deed to a house. This creates new economies for creators and a new paradigm for digital identity and property rights. These applications, from DeFi to NFTs, all run on Ethereum, and every transaction requires its native currency, Ether or ETH, to pay for computational fees, known as gas. Unlike Bitcoin's fixed path, Ethereum is constantly evolving. Its most significant upgrade was the merge, a transition from the energy-intensive proof-of-work system, like Bitcoin's, to a more sustainable proof-of-stake model. Now, the network is secured by validators who stake their own ETH, earning rewards in the process. This not only reduced Ethereum's energy consumption by over 99% but also changed its economic model, potentially making ETH a deflationary asset over time as more is staked and burned than is issued. This programmability gives Ethereum immense use case upside, but it also introduces complexity and volatility. Its value is intrinsically linked to the success and adoption of the thousands of applications built on top of it. Think of it less like a commodity and more like a high-growth technology stock. The network has faced challenges with high transaction fees and congestion, but it's actively addressing these with a roadmap focused on roll-ups. Layer 2 solutions that process transactions off the main chain to make them faster and dramatically cheaper. When our AI analyzes the ecosystem, this dominance becomes clear. It consistently flags Ethereum's role in powering over 70% of the entire crypto application economy. It sees the network effects. More developers lead to more apps, which attract more users, which in turn attracts more developers. This creates a powerful, self-reinforcing cycle. However, the AI analysis also highlights the risks. The investment case is a bet on continued technological execution and widespread adoption. There's competition from other smart contract platforms, the risk of bugs in the code, and an evolving regulatory landscape. The AI's conclusion reflects this duality. Ethereum presents a stronger short to medium term upside potential than Bitcoin, driven by its utility and growth narrative. But this comes with significantly higher volatility and a different set of risks. So, what does an AI-driven framework actually recommend for a regular person looking to get started in crypto? To find out, I created a specific, relatable profile, a 30-year-old professional earning a solid $55,000 a year. They're disciplined, able to set aside $200 every month for investing, and they have a medium-term time horizon of about 5 years. This isn't about getting rich overnight, it's about steady, strategic wealth building. We fed these parameters, age, income, monthly investment and time horizon, into the analytical model. The goal wasn't to get a single magical answer, but to generate a logical, repeatable framework based on the data. The AI processed these inputs against a vast dataset of historical performance, volatility metrics, and correlation data for major crypto assets. After crunching the numbers, the AI produced a clear recommendation for this balanced investor profile, a portfolio split of 65% Bitcoin, 30% Ethereum, and a 5% cash reserve. Now, this ratio might seem specific, but the logic behind it is what's truly valuable. It's a foundational strategy that balances the unique strengths and weaknesses of the two largest crypto assets. Let's break down the reasoning for each component, because understanding the why is more important than just copying the what. First, the 65% allocation to Bitcoin. Why such a heavy weighting? Bitcoin is treated here as the bedrock of the portfolio, the digital equivalent of a store of value, often called digital gold. Its primary investment thesis revolves around its scarcity and security. With a fixed supply capped at 21 million coins and a predictable issuance schedule that halves approximately every 4 years, it's designed to be deflationary over the long term. This mathematical certainty is a powerful anchor in the often chaotic crypto market. Its network is the oldest and most battle-tested, secured by an immense amount of computing power, making it incredibly resilient to attack. For an investor with a 5-year horizon, Bitcoin's role is to provide a degree of relative stability and act as a hedge against inflation, grounding the portfolio against the higher volatility of other crypto assets. Next, the 30% in Ethereum. If Bitcoin is the stable foundation, Ethereum is the engine for growth. It's not trying to be digital gold, it's a decentralized world computer. Its value comes from its utility. Thousands of applications are built on top of Ethereum, from decentralized finance, DeFi platforms that let you borrow, lend and trade without a bank, to the entire ecosystem of non-fungible tokens, or NFTs, which are revolutionizing digital ownership. The network's transition to proof-of-stake has also made it more energy efficient and introduced staking, allowing holders to earn a yield on their ETH. This allocation is designed to capture the explosive potential of this new, programmable financial system. However, with this higher growth potential comes higher risk, including competition from other smart contract platforms and the complexities of its ongoing development roadmap. That's why it's a smaller but still significant piece of the puzzle. Finally, we have that crucial 5% cash reserve. This might be the most underrated part of the strategy. This isn't idle money, it's dry powder. The crypto market is famously volatile. Crashes and corrections of 20% or more are common. For unprepared investors, this can trigger panic selling at the worst possible time. But with a dedicated cash reserve, your mindset shifts completely. A market downturn is no longer a crisis, it's an opportunity. This 5% allows you to buy the dip, to acquire more Bitcoin or Ethereum at a discount without having to sell your existing holdings. It's a powerful tool for both risk management and psychological stability. It keeps you in control, allowing you to act rationally when others are acting emotionally. This 65-35 split represents a balanced approach, but it's not one size fits all. A more conservative investor might increase their Bitcoin allocation to 75% or 80% for greater stability. A more aggressive younger investor with a longer time horizon might increase their Ethereum allocation to 40% or even 50% to chase higher growth. The framework is adaptable. The core idea is to balance a store of value asset with a utility-driven asset and always maintain a tactical cash position. This isn't financial advice, and you should always do your own research, but as a structured way to think about building a starter portfolio in crypto, it's a simple, repeatable, and powerful framework worth considering. What's in your portfolio right now? Bitcoin, Ethereum, or something else? Tell me in the comments. Next week I'm walking through how to set up this exact portfolio split using an AI tool in under 10 minutes. Subscribe so you catch it.